I'm James Abdelmalek with Keller Williams Palos Verdes and Keller Williams Luxury International. I am a California realtor, and as always, I prepared more informative videos that explain different topics in real estate and give you real estate market updates. Remember to subscribe to my YouTube channel and like my Facebook business page, James Abdelmalek Realtor. In today's video, we are continuing our new series called Real Estate Decisions. In my prior videos, I discussed three key factors affecting the real estate market: economics, politics, and demographics. Today, I will discuss the fourth and final key factor affecting the real estate market, which is interest rates. Today, in our fourth episode, Real Estate Decision number 6 will be about real estate and interest rates. In today's video, I will help potential home buyers who are thinking of buying a home in the current time. Also, current homeowners who are thinking of possibly selling their home in the near future. I'm going to help both those buyers and potential sellers determine if it's the right time for them to go into the real estate market, whether you're a buyer, you want to buy a home, or whether you're a seller, you want to sell your home, from an interest rate perspective. I will teach you how to think as interest rates change. As a general rule, the lower the interest rate is, the better it is for you as a buyer to buy, because you will have more purchasing power, and the more convenient time for you to sell as a homeowner, because there will be a lot of buyers in the market who have a lot of purchasing power. So lower interest rates is good for buyers and is good for sellers. So now, who determines the interest rates that's in the market? What drives interest rates up and down? I'm gonna summarize everything in 2 points that, if we understand them, we'll be able to understand what will happen in the real estate markets from an interest rate perspective. Am I going to be getting the interest rates that's in the market if I apply for a loan? We'll find out right now. So the interest rates a buyer gets when he applies for a loan is influenced by two critical factors. The first factor, the monetary policy. The monetary policy is set by the central bank of the country. In our case, in the United States, it's the Federal Reserve. The Federal Reserve determines the monetary policy, which sets the interest rates that everybody's going to go by. The monetary policy is affected by macroeconomic factors. The main two macroeconomic factors that influence the monetary policy are the economy. For more details about the economy, I made a nice informative video about real estate and economy and how the economy affects the real estate market. It's on my YouTube channel, Real Estate Decision number 3. I recommend you guys would watch it. But basically, to summarize, when the economy is doing good, when the GDP is rising and the unemployment rate is low, the interest rates tend to rise as well. The second factor we should look at, which influences the monetary policy, is inflation. Inflation also has an effect on the interest rate levels. The higher the inflation rate, the more interest rates are likely to rise. How do we monitor the inflation rates? From the Consumer Price Index. And all this information we can easily get as public information from the internet. The second factor, personal profile. So we always see, like, for example, they tell us interest rates right now are at all-time low, and they are. For example, at 2.5 interest rates. And then we go and apply for a loan, and then suddenly we discover we were approved for 2.9. Why didn't I get the 2.5% that's in the market? This factor will explain this, the personal profile. Each person applying for a loan has a unique personal profile. Here are the 4 factors under your personal profile that determine what interest rates you are going to get. A, loan to value, or the LTV ratio. Loan to value is simply the amounts you are borrowing from a lender compared to the value of the property you're purchasing. So if you're buying a house that's worth $1 million and you're borrowing $900,000 from the lender to buy this house, then your LTV ratio is 90%. The lower the LTV ratio, the better interest rate you'll be getting, because the more you put from your own cash, the less risk you are to the lender. So he will offer you, as an incentive, a better interest rate. So the way to improve your LTV ratio or loan to value is putting more down payment. The more down payments you put down, the more cash, the better interest rate you'll be receiving. B, debt to income, or DTI. The DTI ratio is simply your monthly debt obligations comprised of, for example, your mortgage, which is the principal, the interests, the property tax, the insurance, and whatever minimum credit card balances you have, whatever car lease obligations you have, all this divided by the gross income you make if you're a W-2 employee, or the net income on your tax return if you're a 1099 contractor. So the lower the DTI, or debt to income ratio, the better the interest rates you'll be getting. If you have a poor DTI ratio, you can improve it by paying off some of your debts in order to improve your DTI ratio. C, FICO score or credit score. The higher your FICO score, the better the interest rates you're able to get. So if you have a FICO score of 680, which will be another lower interest rate if someone else who has a FICO score of 800. So always when you have a high FICO score, that helps you and it saves you on the interest rates. And sometimes it also saves you on the reserves, which is a different topic for another video. D, type of loan. As I mentioned, every borrower has unique circumstances. So if you're going with a conventional loan, you are automatically going to get a better interest rates than if you're getting a jumbo loan. Jumbo loan tends to be more riskier for the lender because it involves a bigger and more expensive purchase. Also, FHA loans interest rate is different than a conventional. So whatever program you're going to go with, it's all going to determine the interest rates. Well, there you have it. Now you understand how interest rates can influence the future direction of the real estate market. And also, now you understand why some people get better interest rates than others. So you'll be prepared when you apply for a loan to improve on those 4 factors to get the best possible interest rates when you're dealing with a lender. My next video is going to be about tax benefits of home ownership. Subscribe to my YouTube channel to be notified about this video when it comes out, and like my Facebook business page, James Abdelmalek Realtor. If you need any further details or more explanation about today's video, text me or call me on the number shown on screen. If you want to sell your home or buy a home or invest in real estate in California, call me or text me anytime. It will be my pleasure to work with you. If you want to buy or sell a home anywhere in the United States, just text me the city and state you're in, and I will connect you with the best local realtor in your area. See you in my next video. God bless.